Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TikToker. We got a fast market in gold here, all over the place, making a low of pretty much 1830. Just get the right numbers in here. We have a fast market condition here. The low that we made was 1838.60, and it did not quite come down to the buy one level expected at 1834. And once it traded above the average price daily and weekly, you can see the momentum really accelerated. Completed the target of day one, sell 1857, and 1868 is the sell two target. But not only did it complete the sell one daily, but also completed the monthly target of 1864. Upon completion of the target, the market on the monthly reverted, and it's trading under the average price. So it's a neutral to bearish on this signal prior to this, and the daily signal is neutral. Let's see what the trade does here over the next few minutes. Let's watch it for a little bit and see what the signal is as far as the sell one daily is concerned. A close below 1857 could precipitate a short trigger. Let's see what the market does. Testing 1, 2. Let's just watch the market for a little bit here. I want to see what the energy is up here. $56, it's coming into a signal that is activating a short trigger. If it closes below at 7:15, it's activating a short trigger. This is an unusual reversion. We've been looking at, as I said, if you look at my videos here for the past couple of days, and in my private trading room here, I've been pretty much recommending as we come into this correction here that you want to cover your short strategies. Now, one of the things I want to comment here, which I looked at, is and we published this to our private trading rooms last night, that as far as the expiration of the February contract is concerned, what I noticed here is that the contract in the spot month is inverted to the back months as the market was down yesterday. And we still had about 59 contracts to take in delivery, which is a pretty substantial amount of gold. And an inversion represents basically the possibility of a shortage of supplies. The same thing as we saw it back in March. And it's because of this lockdown that is preventing, it's disrupting once again the supply chains. And one of the things that I am looking is at the effect that this is going to have, very much the same way that it had back in March, where we saw the premium of the spot month go up $80 against the physical future because couldn't get gold. The premiums in the cash market are exploding, particularly for the silver market. I think, it's an indication of the demand that seems to be in the metals markets at this point in actually taking the physical delivery. So whenever you see this anomaly where you get an inversion in the spot month, it usually represents a shortage of supplies. And what I think we might be trying to make in here is a short squeeze out of those short positions that the central banks are still carrying, which I believe are in the tune of $35 billion at risk on the short side of the market. And if we begin to see interest develop here on the long side of the market from Main Street institutions, pension funds, hedge funds, we could really see an explosive move in the price of gold. The momentum of the market has turned bullish, and the VCPMI expected a reversion to unfold from these levels, which seems to be occurring. And if you noticed, we're also breaking out of this little wedge that's been formed, which essentially is a descending wedge. It's a kind of a bearish flag, which is really a bullish formation. Geometrically speaking, it's a breakout above the resistance of the wedge. And if we trade above 64, okay, which is the monthly mean, then we are going to be activating 1887 to 1917. The current daily target now, and the next target is 1868. Silver as well has exploded to the upside, up $1.17. We saw the market trade above $27 here this morning, and so we are beginning to get explosive volatility, as you can see. And I've been suggesting my traders here that you want to be measuring the risk accordingly based on your profile, because these are the kinds of moves that are going to be pretty average here. In silver, we could see moves up to $3-4 moves in one day. Right now we saw about a $2 move from the low here. And so and as we enter into this the end of the month in January now, the probabilities increase greater that what we're going to see is the winter lows into the middle of February, possibly the end of February, and depending upon the short covering that goes on, if the short side of the market is pressured to liquidate their position, we could see a massive short covering rally. I reserve, and I would suggest that whenever you get this kind of a move, this kind of a inversion, it usually represents something significant is happening underneath the market. So you don't want to kind of get into the middle of it. And when this happens, the AI of the VCPMI tells you that you want to stop selling short to open, and you want to look to buy corrections only into the levels of support, into the buy one or buy two, ideally. And ideally, when they are in harmonic alignment together between the daily, the weekly, and the monthly signals. The area between the cell 1 and the cell 2 level that we're looking at, they pretty much represent the area of supply, identify where the highest probability of the supply can be coming in. And so when you take a look at the monthly, you're trading around the average, and the weekly cell 1 is at 1887, 1917. That identifies where the supply can be coming in or where the highest probability to find sellers has been identified. And so getting this confirmation that on January the 19th, the low of 1800 tested this lower level of support that was expected to find buyers. When it's in blue, it's expected to find buyers. This reversion confirmed that this potentially was going to be the bottom, the winter lows. And now that we're getting through the 1864, it's confirming that this is the bottom. And upon confirmation and a close above 1864, it will challenge the next levels above, which are the 1887 and 1917. So as you can see, this is the way the algorithm is written in C++, and this is exactly what it tells the robot to do. It bought 1813 1822. It took profits. 1845, 1864. Now it's neutral. Now it's saying if it closes above 1864, buy at the market. That's the actual code given to the robot. And the market will do what it's going to do. So I'm teaching you as a courtesy here in this streaming live platform, pretty much had to trade like a robot without emotion. And it doesn't mean that it's going to be right all the time, but the more that you take your emotion out of the equation, the more success you're going to have and the better results you're going to have in your trading. So we're getting a lot of confirmation on gold here that we're breaking out. Let me take a look at the silver market here. Obviously, is in a big breakout here. As you can see, this green bar reverted exactly from the average price. And this is why I keep pointing out to you the harmonic relationship. You know, we had the daily aligned almost exactly to the weekly. And whenever that relationship occurs, it's the highest, one of the highest probabilities to expect a reversion to unfold. If we were to close below it, you know, it would have been very bearish, but it tried to, and you can see, came right into the daily numbers almost at 2484. $89.50 was the low and reverted right back up. And so we're looking at the 2733 targets now to be completed, as it has completed the weekly targets of 2645 that we came in this week, anticipating this week, and the dailies for today of 2567 to 2602. If you are not in this market, when nobody wants it, you're going to be chasing it. And pretty much this few days, this week, especially yesterday, was obviously the time to get long. Testing, testing 1 2. A trading closing above 1864 is going to bring into focus the 1868 target, the 1887 weekly, and then 1917. Trading above 1864 is going to activate the monthly trend momentum bullish, confirming the daily and the weekly have also turned bullish. I want to see what the market does when we get up to 1887. So in the meantime, just be patient, unless you have some really deep profits, if you bought it down here, and you want to trade some of it, you can use this pivot points to execute and lock in your profits. But I think we're going to be entering into a fast market. 67, I think target is next year. It's being challenged right now. So we got a pretty friendly picture unfolding here in the metals, that essentially you got to be long, in your core thesis, or your basis of your directional move should be to the upside. We're breaking out of 1864, so we are activating now 1887. We're going to be completing the 68 target daily pretty soon. $64.70 traded last, $64.50. So we are trading, as you can see, around the average price, which is the function, obviously, of what we're looking for as far as the supply and demand. And the trading of it will reflect whether we have more buyers that are willing to pay up here, okay, that will reflect in the price, that will trigger, again, the magnet of 1887. The core basis of the VCPMI, which stands for the Variable Change in Price Momentum Indicator, is exactly that, a momentum indicator. That when the signals are activated, the resolution of the direction of that signal should happen right away. If not, the function of the energy underneath that signal obviously is not as strong as the signal indicates. So you can measure more or less the energy depending upon where it's activated from. The highest probability, again, is from the extreme below the mean or the extreme above the mean. And right now, we came from the extreme below the mean, from the 1800s that we saw a couple of weeks ago. And we're at 1865.50, ladies and gentlemen. That's about a $65, $66 move that we've seen, or just now in the last couple of weeks. So this is again the confirmation that the volatility, the benchmark of volatility, has been broken. My target is 1887 for the weekly. And when you take a look at the monthly targets, they're up into that 1900 level. we're going to be coming out this weekend with a lot of new numbers here for the next month. But for the remainder of this month, if we take a look at the sell one level, using just the numbers from the previous month, the 1864 close is definitely a bullish indication that activates 1950 to 1998. So these are the numbers on the monthly. And of course, if we go back to the annual numbers, the supply and demand for the seasonal period of September 28 of 2020 to September 28 of 2021, you're looking at 2164 is your first target, and 2442. These are the targets that the code, the VCPMI, prospectively is identifying as the high probability levels, where we could see pretty much a reversion to unfold, or target upon target completed. And of course, if we look at the 9-year cycles, again, they're all the way up to 2299 to 2712. So we have a long way to go. And I think it's a question of just being patient with the opposition. I think the correction is behind us. And I think you want to relax into this move, which I think is on the way, that we've been expecting. Congratulations to those fellows that are following us live streaming here and in our trading room. It gave us a bit of a, anxiety over the last few weeks chopping around here, but as once again, it's proving to be that that the indicator definitely is a contrarian indicator, and it validates tremendously the probabilities that we're looking at, that we're trading, which is what we do. These are probability models. It's got, as you see, I've been talking probabilities mathematically, the code, but when you put into the picture, when you put into the equation, the fundamental picture, it is explosive. I mean, yesterday, the Governor Powell, Fed Governor Powell, announced that they are going to leave interest rates as is, and there's no intention of raising interest rates anytime soon. They can't afford to raise rates. In fact, I think we're going to see lower rates here for quite some time, which is what I believe is creating this economic boom in real estate. With interest rates historically low, the cost of money basically the cheapest we've ever seen to borrow. If you can qualify to buy a home, boy, this I think is one of the greatest times to be able to do that. In terms of just in terms of the cost of borrowing, okay. But there is a risk that I think we need to take a look at and address here as we move down the road, so to speak, and we begin to see the real economic impact of this stimulus in the economy, which essentially takes a look at the inflation factor, and we already are beginning to see a great deal of the increase that we have seen in food prices. For example, wholesale food prices have increased over 54%. And you can't deny the fact that with the supply issues, the supply problems that we're having as a consequence of these additional lockdowns that we're having, are going to have an impact. And the impact, I think, is still a big question mark. And so um, I believe our present government is under tremendous pressure to provide as much stimulus as needed. And in fact, I think what we're going to see is massive amounts of stimulus to come into the market. You know, um, back in March of last year, I think the Feds and the Treasury had looked at allocating about 10% of GDP. That's a staggering amount of money. That's about $24 trillion. And so we seem to be moving our way, in spending in that staggering amount of money. And it appears that, we still are not yet fully recovered from this pandemic. It feels like a second wind is coming on, um, as we saw it back in March. Um, and so there are a lot of black swans out there with regards to the economy, but the fact that the Feds are supporting this economy, this crisis, with massive amounts of stimulus is really a safety mechanism. It's like a put for the market that is essentially guaranteeing the financial markets that the Feds or the government will be there if needed to eliminate any systemic risk that may be created. And so what we see is people that understand the consequences of the dollar long term with this amount of stimulus that seems to be coming in, uh, is not bullish for the dollar. It erodes the purchasing power of the US dollar and the intrinsic value as the world's reserve currency. So it basically has been exporting to the world our inflation. And now we are finding ourselves that we need, as the U.S. world's reserve currency, open up the printing presses and print as much money as necessary so that we won't have the credit squeeze, the shortage of dollars that created the 2008 panic in this swap credit market. So that's the thing I believe that is fueling cheap money, is fueling the markets. This stimulus that's going out is obviously going somewhere, and that seems to be going into the market, the stock market. And I don't think that we're going to see the kind of implosion that we saw back in March. I think that caught everybody by surprise and everybody panicked. But if you understand the dynamics of what's happened since that, again, There is tremendous money available, cheap money available. Um, the markets are taking a bullish attitude about this. And so we're seeing reversions or reversals, you might say, for example, on the stock market. Um, and, you know, I think that's pretty much where the money seems to be going as a safe haven. I don't know about that, but the mentality seems to think of this money that needs to find a home somewhere is going into the dollar short term. Stock market is up 54 points. So the correction, I think, in the stocks might have been completed as of yesterday. And you can see the reversion in stocks, right, from the area that the VCPMI identifies it as high probability of finding buyers. 37.03 was the low, and once we reverted right back up above 37.63, it activated the weekly buy one level as well as the daily bullish trend momentum. So it's great for the stock market. This free money just keeps pouring into the stock market. And I think that money is going to find its way into metals, which is why we're beginning to see this potentially massive move that's in the making. $67 was the high so far, almost completing the sell to daily target. And if we close above 1868, the daily model will go neutral, and we'll be looking at the weekly targets of 1887, which what happens when these targets, these 5 perfect Fibonacci levels are completed. The AI moves into the weekly numbers. And obviously, when the weekly numbers are completed, it moves into the monthly numbers. So, and that's how you begin to integrate the daily with the weekly and the monthly patterns. There are no day trades today for day trading. But we are coming out of this area, which represents the average of all the 3 trends. And that's pretty bullish, using this algorithm. And again, as the daily 1868 target is completed, then the cycles move into the weekly, and they begin to roll into the bigger picture, so to speak, integrating itself with the bigger trend. Until that price reaches the extreme above that energy level or above that average price or the mean. And we see then, obviously, the exchange, the core basis of the market, which is the supply and demand. That's what we are trading, is the supply and demand. It's quieting down a little bit here, hovering around the average price, which the AI suggests that you just watch the market if you don't have a trade at that point. If you have an underlying, obviously, inventory that you're carrying, you want to manage it accordingly. But from a directional indicator, as far as the using the VCPMI as a GPS, this is the way that you use it. It guides you into the strongest probability levels, price target levels that you can execute as a self-directed individual, because that's what you're looking to do as a trader. It doesn't really matter what the fundamentals are. It doesn't really matter what people are saying, what CNBC is saying. What matters is that you buy at 1822 and you sell at 1917. That's what trading is about. And, accordingly, you do the same with the same program or algorithm into the longer terms, time frames, target frames. But these numbers are incredible numbers. They're pivot points using our proprietary algorithms that identify these prospective levels all the way into the 9-year cycles that we use. The upper end of the Fibonacci fan trendline resistance is 1902. And we're breaking out of this one here, which is the second support. This down here was the third, or the first level of support, actually. And as the market goes through those fan lines, you can see the upper end of that becomes the resistance trend line. And so we've come down pretty much trading between the Fibonacci fan lines. And now we found a bottom here, confirming right into the blue levels of the code, reverting right back up, breaking above the descending wedge. And now we're looking to go up and complete this target here of 1900. And right above it, obviously, is the 1917, which is the weekly. So it is suggesting that what we're going to see is possibly a rally into this area, and it's going to take out all the selling that it's looking to find up here, and that's what the market is. Greater buyers will take all the supply available and would reflect in higher prices. Sellers, great supply with very weak buy-in, would reflect in lower prices. The basic core of supply and demand. The move that occurred this morning, making a low of 1838 and came right above the daily average and weekly average, activated this powerful bullish trend momentum. And you can see the targets right above were completed right on schedule. And we're trading around the 1864 monthly with a daily above it at 1868. So more than likely, when the price reaches the average price, as you can see here, it's going to trade a little, around it. And the VCPMI is pretty much telling you that when you are trading around the average, that it's a 50-50 standard deviation. You don't need to trade as a self-directed trader. I only look for the highest probability trades, and that is to buy into that blue level and ideally to sell at the extreme above that level. And I can position my inventory accordingly. We have a massive reversal on the derivatives underneath this market. Nugget, which is a 2-to-1, is up about 4 or 5 points, 462, up 7-8% in one day. That's a incredible amount. But these is the kind of volatility to expect on these ETNs, the 2-to-1 ETFs. The velocity is 2-to-1 to the underlying instrument. And so you get these kinds of moves of 10%, in some days you get 15, 20% in extreme conditions. And to be able to do that on a security overnight or on a day is unusual. So these are unusual instruments, and you don't want to hold these instruments for a long time as much as trade them. What you want to do is you want to look into holding on to some of the indices like, GDX has tremendous volatility as well, but this is the underlying ETF, the VanEck Vectors ETF. And this is what I trade. You don't need to be, in every market. You just need to customize a portfolio for you that suits your profile, your personality, and consistently you can manage it by using the directional signal of the VCPMI. You don't need to be in every market. You don't need to trade every tick. It's all about risk management. Congratulations once again to those self-directed traders that are following me in the live trading room here. If you've taken the position, you've done very well. It's going to be trading into this average price for a little bit here, I suppose, which is what the average price does. And um, it will give us an idea of, the kind of buying or selling interest developing up here. Trading sometimes means being objective, just watching. It doesn't mean that you have to buy or sell to consider yourself a trader. We've been tracking this 1864 price level here for the last few weeks, and it seems to be a pretty important price level to accomplish. So I think you're going to see some, good amount of trading at this level until we can get a clear picture about the momentum that's underneath. And the 1874.60 price was traded on January the 20th. 1874.60 is probably what's going to be challenged up here. And getting through this price obviously is going to accelerate the targets that we're looking at of 1887. So I'm very, very comfortable holding my core position long. We've taken some nice profits short term today. There's no, short triggers activated for day trading today. So I would suggest to continue to hold your core position long and use any correction in the market basically to start accumulating more longs as the market obviously is confirming that it does not want to go down from these low levels that we saw now at 1832, which are the higher levels now that's been tested for 2 or 3 times, okay, upon the initial trigger point activated from that 1800 level. The 1810 signal, buy signal activated with the 360-day average price activating the bullish trend momentum. So we have the annual bullish trend momentum being activated. We have the monthly bullish trend momentum being tested right now, being activated above 1864. And we have a bullish daily and weekly bullish trend momentums unfolding. That to me is a pretty bullish picture. And we need the monthly now to confirm pretty much all of this. And I think once that is done, we're going to be off to the races into that 1900 level expected. Thank you once again, ladies and gentlemen, for the opportunity to share this incredible information with you. And I really do sincerely hope that you are benefiting from this every time that you come here every day. Please take care of yourself. I'll talk to you next time. Be well.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John Najarian here with Steve